Welcome to the deep dive. Today we're getting into something that sounds, well, a little dry, but it's actually the foundational scorekeeping for your wealth. We're talking about the basis of assets.
Exactly. It's not just tax math.
No, it's the core mechanism for everything you own, from your house to your business equipment.
Right. And understanding basis is, it's really the shortcut to understanding your actual profitability. You have to forget the sticker price for a second. The basis is the amount of your investment in a property for tax purposes.
And it's so often overlooked.
It is until it's way too late. And we care about this number, this basis, because it's the foundation for calculating huge deductions. We're talking depreciation, amortization, things like that.
And the big one when you sell.
The biggest one. It's what determines your taxable gain, or hopefully not, your deductible loss when you finally get rid of that asset.
So my assumption would be if I buy a machine for $50,000, my basis is $50,000. Simple.
And that's the starting line.
Our mission today, then, is to show you why that assumption is only the beginning. We're basing this on the IRS rules, specifically from Publication 551. We need to look at the initial cost and then the entire ecosystem of adjustments over the life of the asset.
Let's unpack that, because you're right. The initial cost basis almost never stops at the price tag.
Okay, let's do it. We're moving beyond just the cash paid. What actually constitutes that initial cost basis?
So it absolutely includes the price you paid, whether that's in cash or assuming debt or even trading other property or services for it.
Sure.
But, and this is immediate, you have to capitalize certain other expenses.
Meaning you add them directly to the
You add them directly to the basis.
Yeah.
They're considered necessary to acquire the property and get it ready for use.
Okay, give me some examples, maybe some surprising ones that I wouldn't think of as part of the asset's price but have to be added to my basis.
Think about anything related to the physical transfer and setup. So sales tax, for one, freight charges to get it to you, installation fees, testing fees, and for real estate, here's a key one: real estate taxes. If you, as the buyer, agree to pay taxes that were legally the seller's problem,
And they don't pay you back for it.
and they don't reimburse you, then those taxes become part of your basis. You can't deduct them as taxes in that year.
That real estate example really hits home. Those closing statements are just a minefield of different fees. So when I'm looking at that settlement sheet, what should I be looking for to capitalize versus, maybe deduct somewhere else?
It's a critical distinction.
Yeah.
You include any cost that's directly necessary to perfect the title or just acquire the asset itself.
Like what?
That means things like abstract fees, charges to install utilities, legal fees for a title search or to prepare the contract, land surveys, transfer taxes, and your owner's title insurance. All of those are part of the acquisition.
And what do I absolutely leave out? I'm guessing anything to do with the loan.
Precisely. You cannot include charges related to getting a loan. So that means casualty insurance premiums, any rent or utility charges you paid before the closing date,
Okay.
and definitely charges connected to the mortgage. So points, mortgage insurance, appraisal fees that the lender requires. And here's a little wrinkle. If the seller pays points for you to get your mortgage, you actually have to reduce the home's basis by that amount.
Because you received a financial benefit.
Exactly.
Okay, let's talk strategy. Let's say I buy a commercial property. It's a piece of land with a building on it. Maybe the building's not in great shape. I pay one lump sum for both. How do I start splitting that basis? Because the land isn't depreciable, but the building is.
You have to allocate it. You take that lump sum price and you split it between the land and the building based on their fair market values. Or, sometimes you could use their assessed values for property taxes.
And if I don't, the IRS would just...
They'd assume it was all for the non-depreciable land,
Yeah.
and you'd lose out on all your depreciation deductions for the structure.
This is where it gets really interesting and, frankly, a bit counterintuitive for me. The demolition rule. So I buy that property, and my plan all along is to tear down the old building. I spend $20,000 on demolition. Can I deduct that $20,000 as a business expense?
And that is the strategic nugget right there. The answer is no, you do not. Demolition costs are not a current deduction. They must be added to the basis of the land where the building used to be.
Wait a minute. So if I add $20,000 to the basis of the land, and the land isn't depreciable, that money is basically stuck there until I sell the property, which could be decades from now.
That is the exact takeaway. You've capitalized that cost into an asset, the land, that gives you zero tax benefit until the final sale. It'll lower your capital gain way down the road, but you lose the immediate tax benefit.
That's a huge deal for cash flow in year one.
Huge. Business owners have to know that going in.
Okay, so that's the starting line. Now, what happens over the life of the asset? Let's talk about the adjusted basis. And we can start with the things that, increase your score.
Right. So your basis increases with any cost that's properly added to a capital account. We're talking about significant lasting improvements. Things with a useful life of more than a year.
So not just repairs.
Not just repairs. These are things that prolong the asset's life or really increase its value.
So what are some key examples? I mean, beyond just building a whole new wing on a building.
Well, replacing an entire roof structure, not just patching a leak,
Okay.
paving a dirt driveway for the first time,
Yeah.
installing central air conditioning where there was none before,
Okay.
or a complete rewiring of the electrical system. If it makes a property better than it was when you got it, it's generally capitalized.
I want to focus on something that I know confuses a lot of property owners. Local assessments. My city assesses me $10,000 to pave the road out front. Is that a deductible tax or does it increase my basis?
That's a great question, and usually it increases your basis. Assessments for local improvements like paving, sidewalks, new water connections, things that actually increase the value of your property, they must be added to the basis.
Why not a tax deduction?
Because you're not just paying a tax, you're essentially buying a permanent improvement for your specific area.
So if the city turns the street in front of my restaurant into a fancy enclosed pedestrian mall and I get a $50,000 assessment for it, that whole 50 grand gets added to my property's basis.
Absolutely. And the sources point out that for a business property, that assessment for the mall could even be considered its own separate depreciable asset. You get to recover the cost, but it starts as an addition to basis.
What about non-construction costs, like legal fees? Are those just an automatic business expense?
Only if they're about protecting or improving the asset itself. So legal fees to defend your title to the property, or costs related to fighting for a zoning change, or even legal fees to get a local assessment lowered, all of those are added to your basis.
Okay, now let's get into a really strategic choice you mentioned, deducting versus capitalizing. You're saying I can sometimes choose to capitalize costs, even if they might otherwise be deductible. Why on earth would I do that? Isn't an immediate deduction always better?
That's the key strategic trade-off. An immediate deduction is great if you have current income to offset, for sure. But what if you don't? What if you're in a low-income year, or you want to maximize a different credit that has limits?
So by choosing to capitalize, say, carrying charges like interest and taxes during construction.
You're effectively banking that expense.
Yeah.
You're preserving it to either reduce your capital gain later on, or maybe to increase your depreciation base for the future.
It's a forward-looking decision. I might capitalize if I'm in a low tax bracket now, but I'm expecting a big gain when I sell in 10 years.
Precisely. You trade a current ordinary deduction for a future reduction in capital gain. And the same choice applies to the costs of removing architectural barriers for the disabled. If you don't claim the disabled access credit, you can elect to capitalize those costs instead.
All right, now for the painful part. Decreases to the adjusted basis. What chips away at this value?
Generally, it's anything where you've already recovered the cost through a tax benefit.
Okay.
So the biggest ones are depreciation, amortization, and depletion that you've already taken. Also, the Section 179 deduction, that immediately reduces basis by the amount you expensed.
What about something like a casualty loss, a fire or a storm?
Yes, if you have a casualty or a theft, the amount of the loss you deduct, plus any insurance money you get back, all of that decreases your basis. It prevents you from double dipping on that loss value.
And we also have to account for government incentives, right? Credits and subsidies.
We do. Things like subsidies for energy conservation, some residential energy credits, certain vehicle credits, they all require a corresponding reduction in your basis. Unless, again, you elect not to take the credit.
Yeah.
It's all about preventing you from getting the benefit of the credit and a higher basis later.
Let's spend a minute on a modern complexity. The MACRS partial disposition rule. This is a big one for business owners. If I own a commercial building and I replace a major component, like the whole HVAC system, I can elect to recognize a loss on the old one I'm throwing out. How does that translate to a basis decrease?
This rule is so important. Before, you just capitalized the new HVAC, but you couldn't recognize a loss on the old one because it was considered part of the building. Now you can segment it.
So if I replace that old roof...
First, you figure out the adjusted basis of just the old roof you're abandoning. Let's say its original unadjusted basis was $10,000, and you'd taken $6,000 in depreciation on it over the years.
Okay, so its adjusted basis is $4,000?
Right. By making the election, you can take that $4,000 as an ordinary loss right now. But, and this is crucial, you then must reduce the adjusted basis of the rest of the building by that same $4,000.
That makes sense. You take the loss now, so you have to reduce the building's remaining basis. It ensures you don't keep depreciating something that isn't there anymore.
Exactly. And then the cost of the new roof is capitalized and depreciated all on its own. It forces you to have amazing records down to the component level.
Right, because the IRS wants to make sure you don't get the loss and keep the high basis for later. Are there other big reductions we should mention?
A few quick ones. Non-taxable corporate distributions reduce your stock basis. If you get paid for granting an easement like for a utility line, that payment reduces the basis of that part of your property.
And if the payment is more than the basis?
Then the excess is a taxable gain. And finally, if you have debt that's canceled and you don't have to recognize it as income, say in a bankruptcy, you generally have to reduce the basis of your property by that amount.
Okay, final section. Basis other than cost. This is where all the strategic wealth transfer rules come into play. What happens when I don't buy an asset, but I get it as a gift or I inherit it?
And this is where it's really, really nuanced, especially with gifts. You run into what's called the dual basis rule.
Dual basis. Why would I need two different basis numbers for the same asset?
Well, the IRS uses it to prevent people from easily gifting losses to each other. There are two scenarios. Scenario one is easy. If the fair market value of the gift is more than the donor's adjusted basis, you just take their basis. Simple.
And the tricky one, scenario two.
That's when the fair market value at the time of the gift is less than the donor's adjusted basis. In that case, you use the donor's higher basis to calculate a gain, but you have to use the lower fair market value to calculate a loss.
Let's use an example. My uncle bought a stock for $100. That's his basis. He gifts it to me when it's only worth $60. It's FMV.
Perfect. So your basis for calculating a gain is $100. Your basis for calculating a loss is $60.
So if I sell it for $110, I have a $10 gain. 110 minus 100.
Correct.
And if I sell it for $50, I have a $10 loss. 50 minus 60.
Exactly. But what if you sell it for 80?
80. Okay, well, to calculate a gain, I use the high number.
Yeah.
80 minus 100, that's a negative number, so no gain. To calculate a loss, I use the low number, 80 minus 60. That's a positive number, so no loss.
And that's it. The famous neither gain nor loss moment. You just stop. You report nothing.
Wow. Okay, now let's talk about what might be the holy grail of tax planning, an inherited property. This has to be simpler.
It is much simpler, and it's a monumental tax advantage. It's called the step-up in basis.
Mm-hmm.
The rule is that for inherited property, the basis becomes the fair market value of that property on the date of the person's death.
So if my parents bought their house in 1970 for $50,000 and it's worth $1 million when I inherit it, my new basis isn't $50,000, it's $1 million.
That's the enormous insight. All of that built-in capital gain, the $950,000 that accrued over the decades, it's just gone, wiped out for tax purposes. If you turn around and sell it the next day for $1 million, you have zero taxable gain.
That is probably the most powerful rule for intergenerational wealth transfer there is.
Without a doubt. And for listeners in community property states like California, Texas, Arizona, there's an even bigger benefit.
For the surviving spouse.
That's right. In those states, the basis of the entire community property, so both the deceased spouse's half and the surviving spouse's half, generally steps up to the fair market value. It's a huge benefit.
Okay, one last one. What about a non-taxable exchange, like a like-kind exchange for real estate?
There, the basis of the new property you receive is generally the same as the basis of the property you gave up. It's a carryover basis. If you receive some cash, what we call boot, you might have to recognize some gain, and that adjusts the basis.
What if I trade in something that isn't like-kind? Like I trade my old building plus an old truck for a new building.
That's a great detail. In that case, you must recognize any loss on the non-like-kind property, the truck. And that recognized loss actually decreases the basis of the new building you receive.
So we've really tracked the asset's financial DNA from the very beginning through its whole life. The main lesson seems crystal clear. Basis is not a static number. It is a live, constantly adjusted score.
It is.
And that means accurate, lifelong record keeping isn't just a good idea. It's the absolute key to maximizing your tax outcomes.
It is, and the foresight is so important. We talked about that choice to deduct versus capitalize an expense. That decision you make today for a small deduction that feels good right now directly impacts your adjusted basis years from now, which dictates your capital gains exposure.
It really raises an important question.
It does. When you prioritize those immediate short-term tax deductions, Are you maybe setting yourself up for a much higher, much more painful taxable gain in the future? What stands out to you about that essential trade-off?
For me, it stands out that every tax decision is a balance between today's cash flow and tomorrow's wealth.
Hmm,
Maximizing that basis score, it's like playing chess. You have to be thinking 3 moves ahead.
indeed.
That's the deep dive for today. Good